Right now, the financial media is obsessing over the exact wrong metric. If you turn on CNBC or Bloomberg today, in April 2026, every anchor is asking the same question. What is the Federal Reserve going to do at the next meeting? They are watching inflation prints, debating quarter-point rate cuts, and panicking over every slight fluctuation in the S&P 500. I want to ask a fundamentally different question. I want to ask, where is the smart money quietly moving while retail investors are distracted by the Fed? Because in 4 decades of analyzing macroeconomic cycles, I have learned one absolute truth. The greatest wealth transfers do not happen in the spotlight. They happen in the shadows, during moments of maximum macroeconomic confusion. And right now, underneath the noise of sticky inflation and geopolitical tension, three completely separate wealth windows are opening simultaneously. I have not seen a structural setup like this since the aftermath of the dot-com bust in 2002. Stay with me. I am going to show you exactly what I see in the data. Here is what I want to explain to you today. First, I want to show you the massive, unavoidable physical bottleneck hitting the artificial intelligence sector right now, and why the institutions have stopped buying the tech companies and started buying the utility layer underneath them. Second, I want to expose the true mechanism behind the commercial real estate crisis. Everyone knows office buildings are sitting empty, but almost no one is talking about the $1.5 trillion maturity wall hitting this year, and how it is creating the single greatest distressed asset buying opportunity of our generation. And third, I want to show you the quietest bull market on earth right now, the sovereign defense tech sector, and why a shift in how modern wars are fought is creating a mandatory, price-insensitive spending floor. These are not opinions. These are mathematical certainties driven by supply, demand, and debt maturity schedules. Understanding these sequences is what separates the investors who build generational wealth from those who simply react to headlines. Let us start with the first window, the AI physical bottleneck. For the last 3 years, the entire market has been running on the artificial intelligence narrative. Investors poured trillions into semiconductor companies, software developers, and cloud providers. That was the consensus trade. But right now, in the spring of 2026, the AI sector has hit a brick wall, and it is not a software problem. It is a physics problem. AI data centers require a staggering amount of electricity. We are not talking about a marginal increase. We are talking about exponential demand. A standard chat-gapped query requires nearly 10 times the electricity of a traditional Google search. As next-generation models scale, and as multimodal video and audio generation become the standard, the power grid in the United States simply cannot handle the load. In places like Northern Virginia and Silicon Valley, grid operators are flat out denying power permits to new data center projects. They do not have the electrons to give. Here is the mechanism you need to understand. Tech companies Microsoft, Amazon, Google have massive cash reserves and a mandate to win the AI race, but they cannot run their server farms on intermittent energy. They cannot rely on solar when the sun goes down or wind when the air is still. They require 24/7 uninterrupted baseload power. Because of ESG mandates over the last decade, we have systematically underinvested in natural gas and coal infrastructure that leaves exactly one viable, carbon-free solution capable of powering the AI revolution: nuclear energy, and by extension, uranium. The mainstream media is still treating nuclear energy like a political football, but tech giants are treating it like a survival mechanism. In the last 6 months, we have seen major cloud providers sign unprecedented, decade-long power purchase agreements directly with nuclear plant operators. They are bypassing the public grid entirely. This is the sequence. Massive tech capital is being forced into the deeply constrained utility and uranium mining sectors. Currently, the global structural deficit for uranium stands at roughly £40 million annually. The primary suppliers Kazakhstan and Canada are consistently missing production targets due to supply chain issues and underinvestment. Meanwhile, the demand side is entirely inelastic, a tech monopoly with a $2 trillion market. CAP does not care if the price of uranium goes from $90 to $150 a pound. They just need the power. When price-insensitive buyers meet a structurally constrained supply, you get violent, upward price realignments. Institutional money knows this. The flow of capital into uranium trusts, physical funds, and Tier 1 miners over the last 90 days has outpaced retail involvement by a factor of 10. The smart money is not buying the AI shovel anymore. They are buying the energy required to lift it. Now, while capital is quietly flowing into energy infrastructure, it is violently fleeing another sector, and that panic is creating the second wealth window, the 2026 commercial real estate transfer. The 2026 commercial real estate transfer. If you read the financial press, the narrative is simple. Work from home ruined the office market. That is true, but it is old news. It is the trigger, not the bullet. The bullet is the debt. Right now, we are hitting the peak of what is known in institutional finance as the maturity wall. Between 2026 and 2027, approximately $1.5 to $2 trillion of commercial real estate debt is coming due. The vast majority of these loans were originated or refinanced between 2019 and 2021. Back then, interest rates were hovering near zero, and money was virtually free. Today, the environment has inverted. Those loans are expiring, and they must be refinanced at current market rates, which are radically higher. But here is the mechanism that is creating the crisis and the opportunity. When a commercial building's occupancy drops from 95% to 60%, its cash flow plummets. When you take that reduced cash flow and try to refinance at an 8% interest rate instead of a 3.5% rate, the math physically breaks. The building is underwater. The current owners, many of them syndicators who bought at the absolute top of the market, cannot make the math work. So they do the only thing they can do. They hand the keys back to the bank, and who holds this debt? Not the massive Wall Street titans. Nearly 70% of commercial real estate loans are held by regional and mid-sized banks. When a regional bank takes possession of a half-empty office tower or a struggling retail center, they do not want to become property managers. The banking regulators are breathing down their necks, demanding they shore up their capital ratios. Therefore, these banks become forced sellers, just like the hedge funds facing margin calls. In gold that we discussed earlier, these banks do not ask what is a fair price. They ask how fast can we get this off our books. This is where the wealth transfer occurs. Right now, private equity giants firms like Blackstone, Apollo, and specialized distressed asset funds are sitting on roughly $300 billion in dry powder. They have been waiting patiently for exactly this moment. They are stepping in and buying Class A properties in major American cities for pennies on the dollar. We are talking about skyscrapers and logistics hubs trading at 50%, 60%, sometimes 70% below their 2021 valuations. They are buying these assets at a basis so low that even if the building remains half empty for the next 5 years, they still turn a massive profit. You do not need to be a billionaire to participate in this. The public markets offer exposure through specialized real estate investment trusts (REITs) that focus exclusively on distressed debt and asset acquisition, or by investing alongside the private equity giants themselves. The gap between price and value in commercial real estate is currently the widest it has been since 2008. The banks are forced to sell at the price. The smart money is buying the value, which brings me to the third and final window, the sovereign defense tech boom. For the last 30 years, defense investing was boring. It was dominated by 5 massive prime contractors building incredibly expensive legacy hardware, aircraft carriers, fighter jets, and traditional artillery. But over the last 36 months, the fundamental arithmetic of warfare has completely changed. Geopolitical conflicts in Eastern Europe and the Middle East have proven one terrifying reality. A $2 million interceptor missile can be depleted by a swarm of $10,000 autonomous drones. The legacy systems are economically unsustainable in modern asymmetric warfare. Governments around the world have woken up to this reality, and it has created a structural, panic-driven shift in global budgets. Here is the mechanism. Defense spending is not like consumer discretionary spending. When the economy slows down, people stop buying new iPhones or taking vacations. But the Pentagon does not cut its budget because of a mild recession. Defense spending is a mandatory, price-insensitive floor. And right now, the United States, NATO, allies, and Asia-Pacific partners are all aggressively reallocating hundreds of billions of dollars away from legacy hardware and into software-defined warfare. They are buying artificial intelligence targeting systems, autonomous drone swarms, advanced cyber warfare defenses, and commercial satellite arrays. This is creating a supercycle for a specific breed of defense technology companies. We are seeing Silicon Valley culture merge with the military-industrial complex. Companies like Palantir, Enderal, and a host of smaller, publicly traded aerospace and cybersecurity firms are capturing massive multi-year government contracts that used to go exclusively to the legacy primes. Furthermore, the legacy prime contractors realize they cannot innovate fast enough to keep up. So, what do? Just like the pharmaceutical companies facing patent cliffs they acquire, the M&A activity in the defense tech sector is accelerating rapidly. The major defense contractors are buying up small and mid-cap defense tech companies at massive premiums to bolt on the capabilities they desperately need. Whether you access this through aerospace and defense ETFs or by targeting specific software-defined defense contractors, the sequence is identical. Global geopolitical instability has mandated an increase in spending. The nature of war has dictated where that money must go. The revenue is contracted, the budgets are approved, and the institutional capital is already rotating in. Let me bring these three windows together. The AI energy bottleneck. Tech companies are forcing capital into uranium and nuclear utility infrastructure because they have no other way to power the future. The Cray wealth transfer. The maturity wall is forcing regional banks to liquidate commercial properties at steep discounts, allowing distressed asset buyers to acquire generational wealth for pennies on the dollar. Sovereign defense tech. A permanent shift in global warfare is creating an inelastic, mandatory spending floor for software and autonomous defense contractors. What unites all three of these is the concept I started with, the difference between price and value. Right now, the retail crowd is paralyzed. They are waiting for the Federal Reserve to sound the all-clear siren. They want certainty. But as I have told you, by the time certainty arrives, the price has already moved. The premium has been extracted. The institutional investors, the distressed debt funds, the sovereign wealth managers, they do not wait for certainty. They look for forced sellers. They look for structural deficits. They look for mandatory government spending. They find the exact moments where the market is acting inefficiently, and they deploy capital. These are not recommendations to blindly buy stocks. These are macroeconomic sequences. What you do with this data depends on your risk tolerance, your time horizon, and your financial situation. But the windows are open right now. They will close. They always do. The investors who understand the mechanics driving these shifts, rather than the headlines trying to distract from them, are the ones who will look back on 2026 not as a year of confusion, but as the year their real wealth was built. Whether you choose to act and how you choose to position yourself, that is your decision to make.